This program has been made possible by Wetherby Asset Management. The views and opinions expressed are those of the guest.
Welcome to this edition of Wealth Psychology at Sylvia Global Media. I'm Emily Bouchard, your host for today, and this is our show that we focus on how to lead a truly rich life, no matter how much money is in your bank account. And we define wealth as way more than just money. It has to do with our connections, our assets, our resources, our intellectual capital, our social capital. And today we're going to be speaking about something really important to a lot of people we work with. At Wealth Legacy Group, we work with inheritors, we work with couples, blended families. They're looking at how do we have the money in our lives be a tool towards what it is we want to accomplish in the world, as opposed to having it define us one way or the other. And today we've asked back Deb Wetherby of Wetherby Asset Management to talk about the whole field of impact investing. It's a buzzword, especially here in the Bay Area, that's coming up more and more. And it's around the globe as well, where people are looking at how do I have the biggest impact I can have with the resources and the money that I have. And it's much more so now than just philanthropic giving and charitable giving. It's like, I'm investing my money. How do I want to have an impact in how I'm investing? So Deb Wetherby, welcome back. We're so happy to have you here.
Thanks, Emily.
And when we think about impact investing, I think we should just launch right into, can you tell us what exactly impact investing is so that our viewers and listeners can have a sense of what we're talking about?
Sure. It's the broad term that we're using now to define investments where we want those investments to do more than one thing for us. So we want them to not only have financial return, but we also want them to have some sort of social impact. It might be some impact in the environmental space, or in economic development, or some other social impact that has as well as giving us a financial return.
You know, I was just listening to NPR yesterday as I was driving back from the airport, and Forum with Michael Krasny was talking about human trafficking. And it was astonishing when I heard that, oh my God, over 30 million people are considered to be enslaved in some way. And it was this whole awakening around that. And I could imagine a lot of people listening to that would think, wait, how do I mean, I don't have anything to do with that. That's just depraved people. And then they talked about, no. The companies you invest in, you can actually find out whether or not their practices and their supply chains might actually impact human lives and whether people are being trafficked or not. Is that part of social impact investing? Is that another aspect of it?
It is. So things like child labor or human trafficking, you can explore whether companies are involved in that, and then part of impact investing is also doing advocacy work. So engaging companies in productive dialogues to effect change on issues that are important to you. So this idea of having investments serve more than one purpose, it's not a new idea. We ask investments to serve more than one purpose all the time. We might ask them to produce income for us, or to be low risk, or to be tax efficient. So in the impact space, we're just asking investments to serve more than one purpose. That one common purpose that people talk about is financial return.
Yeah.
But in impact, we also want it to serve a second purpose, which is to do some good in the world. And, you know, I think we used to believe in the financial arena that it wasn't possible to do well and do good. I'm happy to report that the latest research now shows that companies that have positive attributes, so companies that are good places to work, for example, are also good investments. So being a good corporate citizen can actually add to firm value versus subtracting from firm value. So we're in now a new era where we not only think about impact more broadly, but we recognize that these positive attributes, these good corporate citizens, can also be better investments. And so you can do good and do well at the same time.
Well, I love that you would say that, good corporate citizens, because I think that corporations get certainly the bad rap, and especially, the sense of, wait, a corporation's been qualified as a person? Well, I like how you're speaking about it in terms of, yeah, and they can be good, and they can do good in the world. And people can have a right and use the fact that they have these resources to have a voice in how they want that corporation to move in the world. And I'm thinking about clients that we work with that are inheritors, and where maybe they didn't have much say in how the money was made that they are receiving the benefit from. And they often will have this experience of having a distance from the money. It's like it's theirs, they benefit from it, but they don't really. And oftentimes their parents will be like, why aren't they more interested and engaged? They need to understand about money and the investments. And this is a wonderful bridging conversation, because a lot of people that we work with care deeply about the world, care deeply about, they have their core values about, they want to make sure that the money is doing something good in the world, and they want to know that they might have a say in it. But if they've never had a say before, how could they? But if they went to their parents and said, can we, I'm really grateful for the stock that's making all this money, and it's in a company that we like to invest in. We have a lot of stock in this company. Our family's been involved in it. Can we look at some of the practices that are involved in it? Because, I started doing a little bit of research and found out that, there's some children involved in making these products. And can we look at maybe asking this company if they'd be willing to look at their bottom line from a different place? And that could be a really wonderful way to start being engaged, to want to take an interest in research, not just from the how well is the stock doing in the market, but how well is it doing in terms of the things I care about.
Right, and be an agent of change within that company, within that ecosystem. So I think what people don't realize is that business models can be applied to social problems also, and some of the most exciting things that are happening, for example, in poverty alleviation, is using businesses to create opportunities for people to lift themselves out of poverty. So it's not, the old model was more of a, give people a fish. The new model is more teach fishing and create a business that allows them to not only catch fish, but then distribute them or can them, or do something with it that then enriches their livelihood and gives them personal empowerment. And so, this marrying of business and social good now is a really positive, powerful force.
Yeah, and I think a lot of people have that old stance of, I can give my money to a philanthropic NGO, a nonprofit, and now the idea of micro lending, micro investing has come up, and I think there's things out there in the world that people have heard about where they give money and then that money gets used for what you're saying. Somebody can invest it towards a business, and then they can take that same amount of money and reinvest it in somebody else, like it gets returned. Are you saying that you can actually do those investments and get a return on your investment?
Yes, that's the really exciting thing, is that you can participate in supporting those activities by lending money and getting a return on that money. So a good example of an impact investment is a private note with an NGO called Root Capital. And what Root Capital does is it helps agricultural co-ops organize, and it helps small shareholder farmers, instead of selling their goods to a middleman at a low price, they'll sell it to the end user at a higher price. So more of the profit from their crop is captured by the farmer themselves. So in order to do that, they have to be able to have the money to plant, they have to be able to survive the growing season, they have to be able to arrange contracts with the end buyer. So what Root Capital does is they facilitate all that activity. So you as an investor lend money to Root Capital. Root Capital re-lends that money to these agricultural co-ops, or it could be a sewing circle that's selling clothing, or any kind of cooperative that's organized. Root will help them organize and help them with their contracts to the end buyer of goods. And then the notes are secured by the contracts between the buyer and the seller themselves. So, for example, you could do a 5-year note with Root Capital and get a return of 2 3/4% on your note from Root Capital. That compares with doing a 5-year Treasury security at 1.3%. So you're getting a competitive market return. I'm not saying Root Capital is as safe as a U.S. Treasury, but you're getting a competitive market return, and what you're doing is supporting and enabling Root Capital's work with these co-ops that really enhance the lives of these small farmers in developing world countries.
Now, one of the things I know anybody who's tuning in is going to be wondering about when you said not quite as secure or safe is, does Root Capital actually go and meet these people? Do they actually exist? It's not one of those scam things that's out there. Like, how do they know that they're not going to get taken advantage of?
Yes, so they have people on the ground in all these areas who actually go and do research. So they do underwriting of their borrowers just like a bank would do. And what Root is looking for are co-ops that are too big for a microloan, but too small to go into the traditional banking system. So they're kind of in that in-between place where otherwise they wouldn't have access to financial services. And they're also looking for people where they have a commitment to having the extra money that gets created really help the community overall. So they want to see it go into healthcare and education and supporting better livelihoods across the community. So they're really looking at this from many, many dimensions.
Great. Well, and when I look at this slide that you created on Root Capital as one example of it, I like the fact that some people want to be focused, say, like, I really want to have an impact in Africa, or I want to support developing countries in Latin America. Can you choose which of the countries you would want Root Capital to invest your particular investment in, or is it more it's all part of a bigger pot that goes to both those different areas of the globe?
Depending on the size that you're going to loan, you can have some say in terms of where it goes. They also have a general pool, and then they have a specific pool for women and girls.
Oh, that's great. So if you wanted to have an impact specifically for women and girls, and you wanted to have it be loans, you could do it through Root Capital.
That's right. That's
and
right.
is Root Capital one example of, are there many things like this out there, depending on what you want to invest in?
Yeah, there are many things like this, and I specifically wanted to bring an example of a private note because this is one area I think that you can understand how it makes sense on both sides. So as an investor, we understand bonds. You know, you lend your money out, you get paid interest, you get your money back at the end. You know, as investors, you know, that's a structure we're all familiar with. When you think about applying it in the nonprofit space, it's easy to understand how that fits and enhances the mission. So for Root Capital, they take investors' money and re-lend it to these co-ops. Mm-hmm. So you are helping them execute that mission with capital that is very cost-effective for Root Capital versus raising a ton of grant money and just having grant money sitting there doing it. This is money that works and recycles. If you think about another example of a private note, Habitat for Humanity also does private notes, and Habitat is a NGO that many people are familiar with. You know, people participate in building their own home. Well, the Habitat notes, what happens is you lend money to Habitat, Habitat re-lends that money to the person who has built their home as part of the mortgage that they take. So what you're doing again is you're providing cost-effective capital, which then they can use in executing a part of their mission that is very consistent with what they're trying to do overall. And so the really exciting thing about impact investments is that you're unleashing the power of the capital markets using some existing structures that are already out there in a way that supports these NGOs' existing mission and way of operating. So it works well on both sides.
Yeah, I can see where it is. It does create that win-win experience, and I think it really opens up the broader conversation that we're so passionate about here in terms of, you know, this divisiveness that we have in the world between those that have and those that don't, and being able to start really making people aware of, no, people that have are actually doing what they can to make a real difference in the world, to affect change on many different levels, and to make it so that those that don't can have a chance, and that there's easy ways to do that. I'd like our next segment to talk a little bit more about some more examples, and sure, how this actually looks and works for people, so that they can look at, wait, how can I see myself doing this? How do I interface with this? So if you're just tuning in, this is Wealth Psychology at Sylvia Global Media. And welcome back to our next segment. We are going to be speaking with Deb Wetherby of Wetherby Asset Management about impact investing. It's a really hot topic. A lot of inheritors that we work with at Wealth Legacy Group are very interested in how can they make a difference with the money that they have, that they've inherited, that they're beneficiaries of, and how can they start to open up better conversations with their advisors and with their other family members about, hey, we've got all this, what else can we do with it besides benefiting from it ourselves? So Deb's been talking about examples and what this looks like. Now we want to talk about more examples. Can you illustrate for us another example? I think I have another slide for you.
Yeah, so I wanted to give people an example of an investment that's very accessible and doable. And so this investment is a mutual fund, and it's a no-load mutual fund, and it is
wait, hold on. You have to. What is a no-load mutual fund for those?
Oh, I'm sorry.
Might not know.
A no-load mutual fund means it's not sold with a commission attached. So you can go out and invest in it direct at Boston Common, or you can use one of the custodians like Schwab or Fidelity to access this mutual fund, and it trades and is priced every day on the market. This happens to be an international mutual fund. And so it invests in publicly traded stocks. And the great thing about this fund is that they apply all the financial criteria and factors that you would apply if you weren't concerned with sustainability, and then they layer on sustainability factors as well, particularly in environmental, social, and the governance arena. And what they really want to do is use those sustainability factors to enhance the investment portfolio, but to also engage in an ongoing dialogue with management as an investor to really use their position as an investor as a tool for positive change.
Also, is that what the governance piece is? Like, what is this board doing? What's the direction of this company? How are they
What's the composition of the board? How do they treat employees? So they look at these sustainability factors to reduce risk in their investments, to avoid costs associated with environmental, social, or governance factors, but also they use it as a way to evaluate how visionary is the management, how much are they going to look at new opportunities, and are they factoring in all of the true costs of what they're doing in those opportunities. And then they also hope these sustainability factors will allow the companies to become productive, which would make the companies better investments also. So they have done a great job of marrying both the financial factors and the environmental, social, and governance factors. And I put returns on here through June 30 only because I wanted people to understand that you can do things like this and not give up returns. So what I've shown is the returns on this fund versus a benchmark that's appropriate, and you can see.
Yeah, could you say what that benchmark is? And I'm looking at this slide. I see MSCI EAFE index as opposed to the S&P 500, which is what people are used to seeing. So could you explain the difference?
Yeah, so the S&P 500 is a U.S. index. So this is an international fund. So we've used an international index. And MSCI is the provider of the index, like S&P is the provider of the S&P 500. So MSCI is Morgan Stanley Capital International, and EAFE is Europe, Australia, and the Far East. So this is an index, a non-U.S. equity index.
So it's on par with, if I were thinking, okay, I hear people talk about the S&P 500, and that is letting me know how my stocks are doing compared to 500 U.S. stocks and companies that are comparable. And this is saying if I'm in an international fund, this comparison index is looking at international companies that are invested throughout the world the way something like Boston Common would be invested. That's
right.
Okay.
So what you can see is that the returns have been very competitive, and in longer periods they've actually done better than the international index. And what you don't see from this chart is that they've done it with also less risk. So they've had about 90% of the volatility of the underlying index. So they've had 10% less risk, and they've had in longer periods better returns. And as they've done that, they've also effected change through engaging management, through proxy voting, through working with international organizations to trying to affect change.
Now, I want to just jump in because we know what these terms are, but our audience may not. So when you say proxy voting, you mean that somebody who owns a share in this fund can then say, hey, I'm an owner of this company that's doing this work. I want to vote on what they're up to. I want to have something on their next initiatives or ballot in terms of what I want to see them do differently, right? That's what proxy voting is, and you can have somebody else do your vote for you because you don't actually have to be there.
Yes, so Boston Common is the owner on your behalf of all these underlying investments. And as the boards have shareholder initiatives that come up for vote, Boston Common is voting on those shareholder initiatives on your behalf. And what they do is they very actively engage in that process, and they use that as a tool to affect change. So, and because of the size of the fund, they're a powerful voting voice. You know, they're the aggregated voting voice of all their investors. So that has a lot more power than the individual voices.
Now, you said that I individually could invest in them myself, or I could do it through Fidelity or Schwab, and
Right.
that's somebody who is actively engaged in their investing. What about somebody who benefits from a trust, receives a certain amount of money, and really has kind of a hands-off approach to their trust? Could they go to their trustee and say, I want some of my trust to be invested in Boston Common, and ask them to direct some of the investments in that direction, or do they have to do it on their own with the money that they receive from the trust?
I think you can do both things, and I really am a believer in engaging your advisor and your trustees in the conversation, because advisors and trustees respond to their clients, and if they don't know that this is something you're interested in, if you're not letting them know that, if you're not applying pressure, if you're not saying this is important to me, then they are not going to change what they're doing. So one of the things that you can do to be a change maker is to say, hey, I know this is happening out there, and I know there are options, and I know in the old world you used to feel like you had to give up return, but in the new world you don't have to give up return. So I would like, with my money, to find a way to have both financial return and social good. So I would really actively encourage your listeners to engage with their trustees and their advisors, and to really, if this is something that's important to them, to really let those people know that it's important to them, because they will respond.
Yeah, and especially when they're armed with empowering knowledge and language like what we're giving them today, because the more somebody understands how to speak about the markets and returns, and that they can say, hey, look, when this is compared to an index internationally, look at the comparable rates, that gives them a sense of power. That gives somebody who's going in to talk to an advisor a sense of, you know, I understand this language that you've been speaking to me on a different level now, and I want you to pay attention to what matters to me. So that's something that we're really passionate about, is empowering people in getting answers to their questions with their advisors and being heard by their advisors.
Yeah, let me give you one more example of how something like Boston Common can effect change.
Okay.
So we all are familiar with the recent tragedies in Bangladesh because of working conditions.
Oh, okay.
So one of the things that Boston Common has done is that they have gone to all their companies that have manufacturing in Bangladesh. They've also gone to international, U.S. and international agencies to help create a set of standards for safe work environments and have the companies adopt these standards for safe work environments.
Wow.
So those are things that they can do as part of their work with these major companies.
And are they on the ground? Like, do they assess and make sure that the people are actually following through with what they say they're going to do?
Well, typically the international agencies will do that. That's not, the investment manager's job.
Right.
It's really the international agency's job. But it's, I think, a really good example of how the power of that investment portfolio can affect change in a way that might not be obvious at first. And so, you can say, well, I'm just going to exclude those things from my portfolio, but then it doesn't really change the conditions on the ground. It's actually much more powerful to really go to those companies and have them change their way, and that changes working conditions on the ground.
Yeah, that's
so
really.
It's again the change from within, versus just saying I'm going to exclude those companies from my consideration, which is an option, but the engaging them to be different has a lot of power also.
Yeah, it's very inspiring. Well, this is great. On our next segment, I want to speak a little bit more about how to talk to advisors and how to give more empowering language so people understand this whole mode of impact investing and how to have it be more part of their portfolios, whoever they might be working with.
Great. Thanks, Emily.
Yeah. So if you're just tuning in, this is Wealth Psychology. I'm Emily Bouchard, your host, and we're here with Deb Wetherby of Wetherby Asset Management, and we're speaking about impact investing. And we want to really empower anyone who's tuning in about how to speak to your advisors and how to really bring forward your concerns about what is my money doing in the world and how do I have my money have the best impact it can have, not just in terms of my philanthropic giving, which is one arm of it, but also how I'm investing it. And in our last segment, Deb, you mentioned something that I want to touch back into, because you said that there's a fund, the Boston Common, the international one, that is a no-load fund, which means that there's no commission. And when I heard that, that meant to me that my financial advisor, if they invest in that fund, is not going to make any money when they invest in that fund. And so this is one thing that I think people need to be aware of, is when you're asking your advisor, I want to have an impact, you want to make sure that they're really a true, what we would call fiduciary, that's looking out for your best interest in what you want, and isn't looking out for how they're going to make the biggest amount of money as they're making an impact for you. And I want to just tease that out a little bit. You're an investment advisor. You make a living a certain way. Other investment advisors make their money a certain way. Could you explain a little bit about that interface and what people need to be aware of when they're speaking to advisors about this commissions, not commissions, and impact investing? Because I think it's a really important conversation.
Yeah, so your advisor, it's not necessarily true that your advisor won't get paid if you invest in something that doesn't have commission. It just depends on how you pay your advisor.
Ah, okay.
So if you pay your advisor a fee, regardless of what investments they chose, which is how we get paid. Our clients pay us a fee and engage us to be objective and have no conflicts of interest, and to choose the best things that meet their needs, regardless of where they come from or what they are. So we're only paid by the client. then we do get paid choosing impact investments, choosing non-impact investments. If you pay your advisor only by, if they are paid only by collecting a commission from a product that they buy or sell, then they do have incentive to choose certain products over other products. That doesn't mean they're doing something bad. It just means that they have incentives to choose one thing over another. And so you just have to be aware of that. In this day and age, many advisors now are fee-based like we are versus commission-based.
And I like how you say versus, because I think one of the ways we really want to empower people that are tuning in is you want to make sure that they're not doing both and. Because I know there's some advisors where they say, well, we do a lower basis point and you're paying us a fee for this kind of baseline service we provide, and they may be making commissions on another side that they may not be making so obvious to you when you're asking. So it's very important to drill down and find out, how exactly do you get paid if I invest my money with you? And it's a very appropriate question to ask an advisor.
Yes, and the thing that I want your listeners to know is that as a client, they have a lot more power than they realize.
Yes.
And they can ask any question, and they can tell their advisor as much about their needs and wants as they want to. And for some reason, you know, we have, there's been this belief perpetuated that you have to, you know, behave, and that the advisor, you know, has all the power. I want your listeners to know that the client has so much power in this relationship, and I'm not encouraging them to misuse it, but I am encouraging them to embrace it. Yes. and use it on their own behalf.
Well, and you bring up a big part of the wealth psychology piece, which we're so passionate about, because when somebody feels disempowered in this perspective, there may be all kinds of historical things, like perhaps when they were younger and they showed curiosity and interest, there may have been some messages, verbally, non-verbally, that let them know that was not okay, that it was better to sit back and let somebody else manage it. Don't question me. You know, from a you know, power control differential, who knows what might be there that gets in the way of feeling like you can ask. And there's this being, you know, behaving that comes from when we're much younger, and also this sense of, I don't understand this. And when I ask a question and I don't understand the response, I can feel quite embarrassed, ashamed, stupid. Nobody wants to feel those things. Nobody, I mean, that's like those are feelings we avoid at all costs, right?
Right.
So we don't want to put ourselves in a position where we're asking a question where we're going to feel that. One of the things I love about this show and your willingness to come on and talk about this is people can tune into something like this, gain a little bit of knowledge, ask a question, and here's what I want to say. If you ask a question and you don't understand the answer, you need to start really drilling down with that person, because sometimes people will obfuscate. They will say an answer that's not really an answer. They'll kind of give you so much other language and vocabulary and the vernacular or the jargon of their profession that it sounds like they're really knowledgeable and that they've answered it, but you actually may not have gotten your question answered. And you can always say, okay, yeah, I just heard you say a whole lot, and could you just say it in plain English? Like if my 13-year-old was sitting next to me and you were explaining what you just said so that they can understand it, how would you explain it to them? Because that will help me know that I really am on the same page with you about this. It's totally appropriate to ask that from that perspective.
Yeah, and I think sometimes people in an advisory role try to make themselves important by using all the jargon.
Yep.
Versus really trying to establish a connection and explain things and make it simpler to understand. So, but I agree, ask lots of questions.
And I like how your slide was really a great example, because like if I go to my advisor and I say, how is this investment having a positive impact in the world? And then they say, oh, well, here's, it's an impact investment, it's socially responsible, and here's a return it's making. You can ask more specifically, well, on what levels is it being socially responsible? And can you show me, like, how is it measuring that? And how are you measuring that? And ask them to come forward with that, where they can show you with a chart like that. Well, here's how it compares, and here's the different ways that it's looking at it. And if you want to have shareholder involvement, here's how you can get involved. So they're empowering their client as well.
That's great. I'm wondering, Emily, if we want to spend a minute on how your listeners might incorporate impact investments in the portfolio.
Let's have that be our next section. Thank you. Yes. So welcome back to Wealth Psychology at Sylvia Global Media. I'm Emily Bouchard from Wealth Legacy Group, and we're here with Deb Wetherby, and we're going to look at how to incorporate impact investing into a portfolio. So thanks, Deb, for being here.
Thanks, Emily, and thanks for having me on this topic that I love to talk to people about. The slide that is on the screen really takes the standard investment process that your advisor likely uses and layers on in blue the additional steps that would be needed to incorporate impact into your portfolio. So we all know that when you start a portfolio, you're defining your investment needs and objectives. How much income do you want? How much risk do you want to take? What's the long-term objective of the portfolio? When you add impact to the portfolio, at that step, you're also defining what are your core values? What does impact mean to you? What are the things that if you do them are going to make you feel like you have accomplished your objective? So is it economic empowerment? Is it women and girls? Is it environmental? Is it more diversity on boards? What are the things that are important to you that you want to fold into the portfolio?
So is that number, if I'm looking at
that's
this
number
chart right
one.
Is that number one or number two? That's
number one.
Values. Okay.
And then what we do is, as we're developing the investment strategy, we really look at what are the logical areas where we can incorporate impact, where investment capital can play an important role. So if for example, economic empowerment is important to you, then something like a root capital can play a role, and so you know that as part of the long-term investment strategy, private notes can fold into that part of the portfolio. You also can make a decision. You as the investor get to define total return and the mix of social impact and return that you want to have. And so in that section, you also think about, am I going to think about investments first from the return perspective or first from the impact perspective? And if I find something that really meets my impact objectives, but the returns are below market, is that something I want to do or not? Do I only want to do market rate things in this portfolio?
That's a really good point, because I know that I'm working with a client right now, and one of the ways that she really loves to have an impact is in the arts. And so she wants to make sure that her portfolio is generating enough of a return that she's able to give really generously to the local symphony, the opera, a whole organization that develops young and up-and-coming opera stars. Like, that's very important to her, and that's why she wants to have an impact. And so that's a part of her investment strategy, is wanting some of the assets to be making an impact in where they're invested, and also giving her some freedom to be able to give directly to things that really matter to her.
Right. So understanding that trade-off is really important in step 2. In step 3, what we do is we think about our impact allocation first, because we can build the traditional investments around it. So we're trying to integrate these investments into the whole portfolio. So for us, the more challenging piece is finding the fit on the impact side. So we build that first, and then we supplement the asset allocation with traditional investments.
When you say asset allocation, just to really, like, I'm thinking about my 13-year-old granddaughter, you mean like where a particular investment is being invested?
How much of each type of asset do you want? So how much in stocks and how much in bonds? How much in public equity and how much in private equity? Do you want to have hedge funds or not? How much U.S. and how much international?
Okay. The
So
different asset classes and where you can invest.
Different asset classes.
Right.
And that part of that is where is risk and where is opportunity. Part of that is how much risk you want to take overall in the portfolio, and what are your other big portfolio objectives.
Great. Well, thank you. I know that was an outtake. Let's go on to number 4.
Number 4 is selecting your specific managers and vehicles for investment. So this might be the place where you say, okay, I want to have as much of my international asset class be impact as I can. So this is where I might say a Boston Common would fit into this portfolio, and I might choose them as a manager as part of that international allocation.
Great.
So then step 5, really, once you've designed your asset allocation and chosen your managers and vehicles, then you're implementing the portfolio, and you or your advisor probably already has a system for implementing the portfolio. But step 6 is an important step, and the way it's different when you have impact in the portfolio is that you want to think about, with your advisor, how are you going to measure the impact that those investments are having? Because you want to be sure that what you're doing is having the results that you want to have. And we're also used to numbers on a page and sort of the standard portfolio evaluation. In the impact world, you have to look beyond the numbers on a page, and you have to really think about what are the appropriate ways to evaluate outcomes. Sometimes you can use metrics like jobs created or emissions lowered or things like that. Sometimes metrics really are useful, but if you're doing things like human rights or advocacy work, it's hard to use metrics in those spaces, and so then you're looking for what are the projects that have been accomplished, and what are the ongoing projects that you're trying to achieve. So again, going back to Boston Common, where are they in this process of working with the companies and the international agencies to have them adopt a worker safety initiative? How much have they achieved, and how much is left to go? So that's still a really challenging part of impact investing, but it's really important because it reinforces both the need and the desire to continue to do it. So
yeah, I'm thinking about there's stories that keep coming out in the news. I mean, I remember Apple was under fire because there was child labor things happening in other countries that were they said that they had taken care of, but maybe they hadn't. And then there was, was that a trumped up thing, or was it actually true? And I think people really want to know that what they're being told is accurate, and that they really are, as much as they can, making a positive difference. And I'm loving what we're doing with this chart and with this conversation, because it's allowing whoever is wanting to get involved in investing, and in impact investing particularly, to know when and how to interface with your advisors on any level of your investing. And I want to make sure we finish up in terms of 7 before we talk about how we want to have an impact on anybody who's tuning in.
Yeah, so step 7 is just to think about the system and changes that you want to make. And this is a circle because it's an iterative process. I also want to show people the next page.
Okay. Wait, when you say iterative process, what do you mean by that?
Well, you don't think about your values and your mission, and it ends after one one iteration. You're constantly thinking about what's important to you, and your goals and objectives evolve. And so your portfolio also should evolve.
Oh yeah, it's so important. Your life changes, you change, whether you have children or not, whether your parents are aging or not, whether you're married or gotten divorced, or where you are in the world. Yeah, your investment strategy is going to change as life changes, and that is very important to keep that conversation alive. And it's what mattered to me 20 years ago, what matters to me now.
Right.
Yeah.
And so this page has some of those steps that I talked about in the last slide. This actually gives you some questions that you can ask yourself as a part of those steps, so that you would have a way with your advisor to walk through some of those additional steps in bringing impact into your portfolio.
Oh, we're totally going to be posting this on our website. This is fantastic. Yeah, that's very empowering. And if you're not sure how to answer these, that's a great thing to start to engage your advisor in and see how they can support you in that. And if you're not getting answers that feel like you're really being empowered and supported, you may want to look at either how to change the way that you're interfacing with your advisor, or you may want to look at and explore other advisors that maybe you do feel that engagement with, and that they really can support you in understanding the answers to these for yourself, and then how to implement them.
And I know, Emily, that you guys work with clients in that way, helping them understand what it is that's keeping them from engaging their advisor in a constructive conversation around things like this.
Yeah, I think that it's one thing that we're really passionate about is if somebody has access to resources, but they don't feel like they have access to their inner competence in terms of how to interface with the resources and with those people that they've entrusted with those resources, or have been entrusted, that they're then told this is who your trustee is, this is who your advisor is. Understanding what gets in the way is really important, and we clear that out of the way, so then that conversation is so much easier to have and more enjoyable. And then the advisors love it because then they get to do their job even more so and know that their client's really satisfied and that there is that engagement. So yeah, thanks, Deb, for that. Is there more you want to say about that slide, or did you want to go into one other one before we?
No, I think that was the last slide. I do want to say it's an exciting time because in particular for women, I know a lot of your listeners are women, you know, we have now more economic power, and I think embracing that economic power and using it for social good, social change could be really a great lever for change in society. I think one of the things I hear a lot is people worry that the world is not going to be the same place for their children as it was for them. And I think this is a way that we can do something about that, you know, with assets that are at our disposal.
Yeah, I really love that we're having this conversation because, you know, I try to actually avoid the news because it's so depressing and the world does seem like it's just falling apart all around us. And, you know, it can cause us to feel quite overwhelmed, and it can cause us to feel like, how can I, one little person, possibly have an impact or make a difference when there's so much happening, whether it's the environment, whether it's you know, child labor, slavery, oh my gosh, the gun control issue. I mean, I just heard about another school shooting and I just burst into tears. It's like, and that was a child, a 12-year-old. It's like, yeah. It's devastating, and it's like, how can we individually make a difference? And you've just given anybody who tuned into this a way to really know that they can leverage what they have to make a difference in how their money's invested, how they're investing their engagement. And I love the proxy voting. I mean, I could even see somebody saying, well, maybe if I invest in a gun company, I could have a proxy vote that could have them change their policies. Like, you're empowering people to look at things very differently and outside the box, and where they might be able to have a say. And I think that that's why we love having you on the show, to give that perspective and to really empower people and to go out and do it themselves, to be more empowered in how you work with your advisors. And, you know, how is it that you see you want to make an impact today with the people you interact with how you choose to spend your money? I mean, even as simple as, I live in a lovely little town in Northern California, and the town fought not to have a Target in the town. They wanted to keep local businesses successful and thriving. And Target came in anyway. And, you know, Target serves a role, and it's a really affordable place for people to shop who need to shop more affordably. And anybody who's in this town has a choice of where they spend their dollars. And you can choose to go to a big box store, or you can choose to go to a mom and pop shop. And it's always up to you where you're choosing your where you want to have the impact. And right. And I love that we can do it in a small little micro way and in a big global way. So thank you, Deb Wetherby from Wetherby Asset Management, for being
Thanks,
on Wealth
Emily.
Psychology.
Always a pleasure.
I hope we can have you back. Thank you.
Yeah, my pleasure.
Yeah. Have a great day, and thanks for tuning in to Wealth Psychology at Sylvia Global Media. I'm your host, Emily Bouchard from Wealth Legacy Group.
Wetherby Asset Management is dedicated to providing exceptional wealth management services by forming partnerships built on trust, understanding, and thoughtful advice. For more than 20 years, they've been offering objective perspective, personalized planning, and sophisticated investment management to individual investors and families, as well as pension plans, foundations, and endowments. Contact them at www.wetherby.com. Wetherby Asset Management, located in San Francisco and New York City.